Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth Through Value-Add Real Estate Investing podcast. Today, I have Sterling White. Sterling is from Indianapolis, and he focuses in Indianapolis and Louisville, Kentucky. Currently owning almost 400 units with valuation of $19 million. His company is called Zander Investment Group. Hey, Sterling, welcome to the show.
All right. Welcome, everyone. It is Zander Investment Group is one thing I did want to allude to.
Awesome. We will get that right. Zander Investment Group.
And then off camera, for those of you who are from Louisville, he pronounced it Louisville. So that's what I like to do too. So that was hilarious. But get your popcorn ready, everyone. It's about to be a show.
Awesome. Sterling is very popular in Bigger Pockets. I've been getting his blog posts on Bigger Pockets for many years. How long have you been doing that?
Oh gosh, 4 years, 3.5 years.
Yeah, it's a really long time. I remember.
I don't even know what day it is anymore, James.
And you have been interviewed on Bigger Pockets podcast for many times, right?
I would say episode 308. And then also I've been on their Best Deal Ever podcast, which is like a spinoff from their main podcast. But yeah.
Okay, that's awesome. Well, that's Bigger Pockets. This is Achieve Wealth. We are still one of the top 24 real estate podcasts for 2019. So you're in the right place, man. So Sterling, why not you tell our audience about yourself, about your story? Because I think you have a lot of good story to share that can be inspirational to others.
Yeah, so just a little background on myself. I'll give everyone like a Cliff Note version. So born and raised in Indianapolis, as James mentioned earlier, fraternal twin brother and single mother. And we grew up on welfare, Section 8 housing, food stamps, and I'm sure of other government assistance my mother didn't tell both and I about. And I remember the environment that we grew up in just wasn't the best. And I remember one instance, my brother and I were actually sitting at one of those little multicolor, like Fisher Price type tables. We're about 6 years old. And as soon as we get done eating dinner, we go upstairs to, I believe we were playing like PlayStation or Sega or something. And a bullet comes right through the back patio where we were sitting. So I may not be here. He may not be here. But at the end of the day, decided to not be a product of that environment and use that as fuel. Got started in real estate 2009 on the construction side. Fell in love with the industry, not so much getting my hands dirty, and then shifted to the investing. Bought first deal 2013, no money out of pocket, with leveraging my mentor's cash at that time. Scaled up to 150 single families, and then in 2017 made the entire shift to multifamily and scaled portfolio just under 600 units. Exited out of all the single families and now just own multifamily.
Yeah, I remember when I was reading your blog, you were all about single family. Okay, but I did learn a lot. I'm happy that you wrote that blog because
the content marketing too. But that's a whole nother,
Yeah, we're going deep into that because I think writing blogs like that where you generate content, and sometimes people say, "Why do I need to write?" There is definitely a credibility establishment when that happens. So after you finish your studies, you said, did you go directly into real estate? I know we missed that part on how did you move to real estate? Why real estate was the aha moment? I mean, you say you did some construction, but why investment?
Yeah, so I was in college at the time. I actually dropped out at a later point. College was not for me. I took chemistry 1 and 2 a total of 5 times. In context, chemistry.
Chemistry is fun, man. Even though I don't enjoy it, so.
But during those college times, during the summer, my roommate's dad owned a construction company, and he saw that I had some free time, and that's how I got started. He said, "Hey, I see you're around the house oftentimes. And I also was doing entrepreneur ventures, but still. And then that's how I was able to earn some money.
So when you were having free time and when your friend's father saw you, and there must be something that has attracted you to go and try out this, because the reason why you had free time because you didn't find something that was motivating enough for you to go and do, right? But what was the trigger point? Hey, maybe I should go and try that out.
One thing that I always did enjoy and seeing, because also I was able to visit some of his houses that he had because he owned rentals. My roommate's dad did, and also he owned rentals. I really enjoyed the element of seeing a house in distressed condition and then seeing the aftermath. The once the value is created, and then you're able to see afterwards. So the before and then the after. So that's what I enjoyed. And then on the construction side, I was helping the bricklayers. I provided them the mortar to be able to lay the bricks. Huge grind for sure. But after that project I started from the beginning, and then it was on a fire station to look back and say, wow, I was involved with all that. Such a cool experience. And that's when I felt.
Yeah. Didn't you write a blog about it? I remember someone writing a blog, doing a wall. Is that you?
Will Smith has a, I know Will Smith
No, not Will Smith. I mean, this was from a Bigger Pockets somewhere. I mean, either a podcast or a blog where someone said they build a wall. It was very cool, man. That's fine. So how did you move? I mean, so before going to multifamily, so on single family, was there any limiting factor that you had? Because, you're moving from construction to investment side of it. Was there any limiting factor, limiting hurdle that you had in your mind and how did you overcome that?
Yeah, I would say I had no limiting beliefs when I was making that transition. And what really helped with that was feeding my mind as much positivity. So that same roommate that got me started in construction, he has also been pivotal in terms of another aha moment that I had in my life, which was I was at a college party. Yes, I'll call it what it is, and having a good time. And I ventured out on my own. This is my early 20s, and I'm out on this boat. And and I'm all by myself. And there's this beaming question that comes down to me and says, Sterling, is this what you want to do with your life? And I answer back to that question, no, this is not. Since then, I cut off all my friends because they weren't going where I wanted to go ultimately. I cut off all the news because there was so much negativity. And then I started with a lot of self-improvement. And that allowed me to get a lot of the limiting beliefs out and replace those with more empowering ones. And I still believe I have limiting beliefs to this day. And I'm always looking to become self-aware to identify those and replace those with more empowering ones.
Got it. So when you started on your single family, how did you start buying deals? How many single family did you had before you transitioned to multifamily? And how did you buy that deal? And how did you make money out of single family to transition to multifamily?
Yeah, so just got up to about 150 of those, and all started with one. And that very first deal was $25,000. It was in about, I would say, a C neighborhood, C plus neighborhood, and it was not a shed. Those of you who may be on the West Coast or East Coast, you can actually in Indianapolis get some very affordable houses. You couldn't get that for that much now since things have gone up. And I presented that to my mentor. He funded the purchase price and also the rehab. And one thing before all of that happened with that deal, I was working for him for completely free. And that's how I got started in the investing side, was able to compact his 20 years knowledge into the 2.5 years that I worked with him.
Got it. So did you use so you went up to 150 single family houses. That's great. That's crazy because I stopped at 13.
I wish I would have known that sooner.
I cannot take it after 13. But did you have an infrastructure to manage that many houses, or did you have like a system?
Yeah, so ended up from that mentorship, shifted to finding a partner that was very similar in terms of our ages, because I outgrew that original mentorship. And he was behind the scenes of an operation of a operator that managed closer to about 1,000 single families. So he understood how that worked, and we were able to lay the foundation to start building up on that and scale our portfolio.
Got it. And how did you buy these houses? Is it through normal MLS? You did off-market marketing, or what did you do?
A mix of just about everything. So doing the bandit signs That was one route, and I remember doing those way back when. And there was someone who always would go down and take them. So that was one. And
I did that too.
oh, did you?
Oh yeah, of course. We all are hustlers.
Yeah, exactly. It was funny. There was a stapler. You would take a PVC pipe, and then you would take the staple and a staple gun and put it on there, so you can hang the sign all the way up on a telephone pole. Have you?
I didn't do that.
So people just couldn't jump up there.
Oh, you did the more advanced bandit sign. I did the one that you just put in, on the side yard and all that. That's it. But you did the one that is harder, more effective because people can see it from far away and nobody can come and grab it. But you're right. Every time you put in, and after a few days, the city or someone's going to come and take it out, right?
If you put it all the way up there. So that was one route, was purchasing from the MLS, and then also taking the direct to owner approach as well. So a multitude.
Which one was the most effective? Made you the highest money between bandit sign, MLS, and direct to seller marketing?
I would say the direct to seller was by far. The MLS had success with that, but that took a lot in terms of offers, which most of it, whichever channel you go through does. That's the same thing. But in essence, I would say it was the MLS and also the direct to seller approach, which included mostly direct mail.
And how did you transition to multifamily, and why?
Because managing that many single families was a pain in the grass.
But you had someone helping you out, right?
Yeah, there was a whole team that was involved with the
how big was the team?
Both acquisitions, 15 to 16 team members.
Yeah, that takes time. That's why I was
more so on the property management side.
Oh, really? Okay, yeah, I had like 13 houses all on my own, so which is crazy, right? So. That needs a team. 150 houses needs a team. So why did you move to multifamily?
More so, economies of scale was the biggest. And then also looked at, where we want to go in the future, which was ultimately shifting to the multifamily at some point. So why not do it sooner rather than later? So
what are the key learnings that you took from single family to multifamily acquisition and operation?
Yeah, I would say more so is the management. I mean, if you're able to manage that many single families, the same could apply. Of course, there's some more, small day-to-day changes that would be different on the multifamily side. But managing 46 single families is a lot more difficult to manage one 46-unit apartment complex, which was my very first deal in 2017, which was a 46-unit. And then, so there's that. And it's just a lot more labor intensive because scaling to that many single families it wasn't 1 to 2 transactions. There was close to about 100 to 125 transactions because a lot were one-offs, a package of 2, maybe a package of 3 or 4 every so often. And then from the multifamily, that very first deal was one seller, one transaction, all in one single location. So once that happened, it was like light bulb went off.
What do you think, in terms of like value add, right? Because multifamily is valued differently from single family. Did you find that out halfway through? And sometimes people do like single family. I have people who just want to do single family. But I moved from single family to multifamily. What did you see in terms of value add, and how did that change your strategy?
Yeah, I would say that is a great point. So also what was learned is underwriting was a different style. So looking at it from, the NOI is, let's say it's this, we're purchasing at a 7% cap. In, let's say, 5-6 years, we're going to be looking at an exit. Let's be a little bit more conservative at a 7.5 or 8 and not bank on cap rates are so much going to steadily be compressing. So on the multifamily side, we took more so that it's valuated as a business versus on the single family, there's more exits. And so there was, this is one if we exit to an investor. This is one if we exit to a retail. So those were also differences too.
So tell us more about your multifamily journey, like how many units you started and how many units you have right now, and how did you grow each one of that?
Yeah, so started with a 46 unit, then acquired a 50 unit, and after that, 2 80-unit apartments, and then 156 unit. So exited out of the 46 unit, the 50 unit, and now just own the 280 units and the 156 unit.
Why did you exit out from the smaller ones?
Because they were smaller. That was it right there.
But it must have made you a lot of money too, right?
Yeah, I mean the one that was a 46 unit is one that was the boiler system. So that was an older age
Okay, got it.
property. So there was a heating the boiler that was affecting in terms of the expenses. And then also we wanted to be able to push up the rent a little bit more, and we felt a little bit capped off. And also we were transitioning to more desirable assets and just step above in terms of the neighborhoods. And so with all those things considered, and we're not able to have on-site staff, that's why we made the transition selling that one. And then also there was a 1031 buyer too.
Oh, got it. Yeah, smaller one can be a problem with the on-site buyer. So where do you see yourself going from now onwards on multifamily or any other asset classes?
Yeah, so have shifted more from the older style, so the ones that have been built pre-1970s, and shifting more to those in the what you would say B class that have less heavy lift.
So how do you underwrite a deal? I mean, can you walk through your basic sniff test? Because this is a market in the Midwest state. So what would you look for when a deal is thrown to you by a broker?
Yeah, so more so just looking at, and so I go the approach of going direct to owner. So I still do have brokers send over deals, but in essence is looking for cash on cash to be in the double digits. That way, myself as the operator, our team has, when we do the equity split, that we still have enough to provide our partners double digits. So there's that. And our IRRs to be anywhere between 15% to 18% on a 3 to 5 year horizon.
So, but what would you look for? I mean, I'm not talking about a compensation structure. So, basically you say the end result is what they look at compensation structure, right? Before that, you look at the area, the demographic, the household incomes and all that. Before.
Oh yeah. So look at it. We look at the overarching market and ensure like Indianapolis is very diversified in terms of the businesses. You got Simon Property Group, which is one of the largest real estate investment trusts in the world. You've got Eli Lilly, which is one of the largest pharmaceutical companies. You got Blue Anthem Blue Cross, which is one of the largest healthcare. So looking at that from that high level, and then going to the sub market, looking at how are the schools, how is the crime. That's always something that's very significant. And then also, yes, looking at the median incomes to ensure that when we're doing the value add, that sub-market can support it or absorb it.
Got it. So let's talk about off-market strategy that you talked about. How many multifamily deals have you bought using your off-market strategy?
All of them.
Oh, all of, so basically that broker doesn't exist, I guess, right?
No,
So you bought like almost 400 to 500 units on all off-market?
That is correct.
Awesome. So let's talk about that. What kind of strategy did you use to get off-market deals?
So that is a secret. I'm just kidding. I wouldn't do that. So it all starts with a cold call. And I know there's people on here that are a little bit screaming, it's like, I don't know about a cold call. But in essence that's the route that we go is we pull a list. We'll use something such as Reonomy.com or even CoStar.com, not affiliated with either. But those databases, you can pull these properties that are between 75 to 200 units in, let's say, Indianapolis, Indiana, or Austin, Texas. And then from there, further narrow down the list and say, okay, I want the assets that haven't been sold in the most recent 5 years. And then further narrow it down, I want the rents, market rates between $700 to $1,000. And then that is very niche of a list. Most of them will be owned in an LLC, so skip trace the LLC, and then find the person's the principal, the owner, and then give them a call.
Got it. Well, I do a lot of off-market as well, so that's what I want to understand. How are you doing it and all that? But it's impressive that you found all of your deals off-market. I think I found like almost 3 of my deals were off-market out of my 9 deals that I've done. Right?
Yeah, it's a whole separate infrastructure. Is one thing, because you think of it, when I first started building that out myself, I was the one that headed all of it. So that's a full-time job because that's what brokers do on a full-time basis. So I was doing that on top of everything else, but then I decided to document what I was doing, put an infrastructure in place, and now hire people to do that. And then now when an owner raises their hand, they just set the appointment with me.
So what kind of infrastructure did you have to do that? Because that's a lot of work.
Yeah, it is. So a researcher is the first one, and that's the person I'll provide the criteria to. They'll go to St. Louis, Missouri, pull all those properties, and then most are owned in LLC, so they'll skip trace the LLC. Second role that comes into play is the cold caller, or they're the one that places all the outbound calls. And then the third is, you could say, the acquisitions manager, where the appointment is set with me, where I then hop on the phone call. One of the questions I always ask right from the beginning is, why now being open to selling? Just to understand if there actually is a motivation. If they're saying, I just want to hear your offer and I'm looking for something that I couldn't resist ultimately, and then I would sell, then that person wouldn't be a good fit. But if there is something to where not a slam dunk deal, especially in today's environment, then that's when I would retrieve the T12 as well as the rent roll to start the underwriting process.
So where do you get the list for the initial, search?
Reonomy and CoStar.
Reonomy and CoStar. So do you use both of it, or do you use both in conjunction of each other?
I use Reonomy right now, and formerly I would use CoStar because I had the agent that we used apartments.com, and they had access to CoStar because CoStar bought apartments.com.
CoStar owns apartments.com, yes.
Yeah, so they would just send that from the data that I wanted.
How accurate is Reonomy owner information?
Not accurate. Same with CoStar. And I'll give you all a prime example for CoStar, which is one of the most reputable, if not the most reputable when it comes to data. Had a representative, one of their reps, in the office of one of the apartments that I have here in Indianapolis. And I said, could you pull the data on this specific property? And they pulled the property and also the owner information. I said, my information is not there, and I've had this property before. I was like, don't add it, but yeah.
The same thing happened to me when I first talked to CoStar. I told them, hey, can you pull my property? And it's under somebody else's name. And okay, forget about it. Right?
Yeah, exactly.
No point of selling anything else to me.
So it's just one of those things that, yes, these places are a good starting point, but still you have to go the extra mile and actually do your own due diligence.
Yeah. But that was like almost 5 years ago. Maybe they're better right now, right? So okay, after you get the data from Reonomy, you basically do skip tracing. What software do you use for skip tracing?
So public records. So haven't found a absolute science when it comes to skip tracing the LLCs. I've looked for just about anything. So if anyone who's on here who knows a software or a service that offers that, I would love to hear about it. There's some I've actually looked into, but they don't work. So the route is to go public record to find out who filed the articles of organization.
Okay, after that, how do you find their information?
You use a source such as benverified.com, benverified.com, or there's truepeoplesearch.com, whitepages.com, just one of those providers to type in their name. Hopefully it's not as common as John Smith.
Yeah, I've heard about being verified. I've never really used it, but I've heard about it. That's good. So now you have all the information, the owner's information. You're going to get your acquisition person to call these owners, right? Mm-hmm. So how would they first call, and how would they pick up the call, and how would they approach the sellers?
So sometimes it does vary on script, whether they get the gatekeeper or they get the decision maker, but it's more along the lines of, hey, it goes ring, ring, ring. Hey, John. Well, I'll speak from my side is how it would go. Hey, ring, ring, ring. Hey, Sterling here. Jim, did I catch you at a bad time? And then the person on the, or we could just do some role playing right. Or no. I'm just going to go into some role because
I'm a tough guy.
Because this is what I do with the team is that we do role playing on a daily basis.
Got it.
We're back and forth of objections, but the opening is just more so, hey, Sterling here. I just bought Bentwood Apartments across the street from yours and wanted a person to reach out to see if you consider selling. So it's more of just straight to the point, transparent. Then from there, a lot of times they'll say, not interested. John, I completely understand. I'm sure you get these types of calls all the time. Tell you what, give me 30 seconds. If you don't like what you hear, I'll hang up on myself. So that's how the dialogue goes. And then we also go into some additional questions.
Yeah, I get a lot of calls too. Maybe one of that is your guys too. I never know. Because you mentioned Austin in the beginning that you're looking at. But I will say, I'm not interested. Forget about it. Because sometimes you're very busy on the phone. During our daytime, and suddenly someone calling and asking something irrelevant. We want to hang up as quickly as possible. But that was a good line that you said, hey, give me 30 seconds, so that I can explain that.
You're just looking to buy as much time as possible.
Correct. Yeah. It's all about connection and numbers, right? End of the day, right?
Contacts equals contract.
Yeah, and that one person who said yes to you could be a $10 million deal, right? So
yeah, that deal that we were talking about offline was a $7 million deal, and that all started with a cold call. And of course, many people see, it was a cold call that closed on this deal, but you don't see all the contacts and all the work that happened until it got to that point.
Correct. We made millions of dollars just by cold calling, cold texting. That's what I use.
It works. It works. But at the end of the day, whatever channel anyone uses, it's about consistency.
Yes. You can do broker relationship, but I think it's, you probably get a normal deal. At the same time, for a newbie, it's just so hard to get with brokers. They already know you're a newbie and they're not going to waste time giving you the best deals out there. Right. So that's good. So let's talk about content marketing, because you are an expert in content marketing to get investor acquisition. Let's walk through that process. How did you thought about content marketing? How did that have worked out for you? How does the investors are attracted to come and connect with you through content marketing?
Yeah, so it all started with the book Jab, Jab, Right Hook by Gary Vaynerchuk. Phenomenal book. He's an influencer out there, but in terms of that book, planted the seed. And in essence, jab, jab, jab. The jab is value, content marketing, free content. And then the right hook could be invest with me. What does it go with my coaching, or whatever your services happen to be. But the original title of the book was supposed to keep saying more jabs. And that's the exact process that I take, is put out a lot of content, a ton of content. And then also I use Grant Cardone's 10X rule philosophy with pushing out a lot, because the thing is, it's so noisy in the marketplace. So overall, from the content marketing is to provide value. And those of you who are just getting started that are thinking, I don't know what value I can create, share your story. People would want to hear your story, and also document your journey as well as far as the content.
Got it. So what are the content channels do you use? Blogs, podcasts?
All of it.
YouTube and all. Okay, so you're on all of it.
Yeah, I would say more so now is I've pushed to the video side. And so I have my own podcast, Real Estate Experience, which James is on, and that will be airing soon. So there's that is one channel. And then also I use all the social media platforms to post that content. So on the audio side, iTunes, SoundCloud, Spotify through the podcast, which a lot is shifting more to the, listening, and then have the video side, got YouTube, got Facebook, got Instagram, in which I could take, like what you're doing here, James, is you could take the video from this and be able to post it on all those platforms and repurpose it.
So which one do you think is the most effective in terms of connecting with investors and
I would say in terms of when I got started, Bigger Pockets was huge. And then also being on others' podcasts really helped. Just those two channels alone. Of course, I had a multitude of other channels, but those two really did help with brand awareness.
Got it. That's awesome. All right, Sterling, I'm sure you had a lot of tons of value to our listeners. Why not you tell our listeners how to get hold of you?
Yeah, so you can visit Zander Investment Group and contact me on there. My email is sterling@Zander Investment Group. And also, I'm on Instagram, Sterling White Official. If you have any questions, slide into the DM with any questions.
And how do you spell Zander?
SONDER Investment Group.
Okay, SONDER. Okay, got it. Okay, awesome. All right, thanks for coming on the show.
All righty, have a great one, everyone. Keep being awesome.
Thank you.
Night.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.